and welcome to Startup Street. I'm Aishwarya Anand, and here are the top headlines from the startup space. VC investments into Indian startups dipped to their lowest level in 28 months, as per venture intelligence data. Startups raised $340 million in April compared to $2.9 billion in the same month last year. That is an 88% decline. April also saw the lowest funding in 2023. E-commerce unicorn Meesho announces a second round of job cuts. CEO admits to overhiring as the company lays off 251 employees. Indian startups have laid off over 6,000 employees in just the first 4 months of 2023. Big tech continues to deliver as Apple's quarterly earnings beat estimates. India business sets a new record, clocking double-digit growth. CEO Tim Cook says India is at a tipping point and is a major focus for Apple. BlueSmart bags $42 million in Series A2 round. The EV ride-hailing startup expects its core market, Delhi NCR, to turn profitable by August. Aims to turn unicorn in 6 to 8 months, co-founder Anmol Jaggi told CNBC-TV18. Healthcare SaaS company THB raises $20 million in a growth equity round led by Filter Capital and Edelweiss Discovery Fund Series 1 and others. THB plans to use the funds to expand its operations globally and accelerate growth in existing markets. Bumble beat estimates for first quarter revenue as user spending on its dating app remained strong. The company reported revenue of $243 million in Q1 compared with analysts' estimate of $241 million. The White House is pushing Silicon Valley CEOs to limit the risks of artificial intelligence. President Joe Biden met with CEOs of top AI companies including Microsoft, Google and OpenAI and made clear that they must ensure products are safe before they are deployed. Now to the top story from this. Well, those were the headlines we were tracking for you this evening. To the top story from the startup space, in a fresh round of job cuts, e-commerce platform Meesho has laid off more than 250 employees. The management said that they made an error of judgment by overhiring ahead of the curve. Akhil Vishwanath is here with the latest. Akhil, layoffs across the startup space. Tell us more.
That's right. Meesho has cut jobs for the third time in the last 1 year. If we include the 251 employees who have been fired in the latest round, the social commerce unicorn has let go more than 700 employees since last April. The company says it was a difficult decision, but a necessary one, as it looks to turn lean to achieve sustained profitability. Co-founder and CEO Vidit Atre, in a letter to employees, said the macro climate has undeniably and considerably changed. And as a result, the company has had to accelerate its timeline to profitability by tempering its growth targets and staying highly prudent when it comes to costs. Atres even admitted to judgment errors in overhiring ahead of the curve after the company witnessed stellar growth during the pandemic. Meesho is not alone in trying to cut costs to rectify the error in thinking that pandemic-era growth will last forever. We need to keep in mind that the funding winter has made it tougher to raise funds to keep up the cash burn. The firing spree, which began early last year, has led to over 90 Indian startups laying off more than 25,000 employees. 6,000 employees have been let go in the first 4 months of 2023. Now, besides Meesho, several unicorns have also cut jobs, the largest of them coming in edtech, with Byju's and Academy and others slashing jobs in their core businesses and at subsidiaries as well in multiple rounds. Back to you.
Thank you, Akhil, for those details. Now, these layoffs have partly been a result of a deep funding winter. According to Venture Intelligence, funding has dropped over 80% since last year, as the Indian startups have raised only $2.4 billion in the first 4 months of this year, compared to $14 billion in 2022 and $11 billion in 2021. It was the second half of 2021 when funding skyrocketed, making it the record year flush with $35.6 billion in capital. Now, if we just look at the month of April, funding has dropped by 88% since last year. Indian startups have bagged $340 million as compared to $2.9 billion in April. Last year, April has seen investments dip to a 28-month low. Now, let's also take a look at the deals this week. According to Venture Intelligence, startups raised $196 million. EV cab operator BlueSmart raised $37 million from existing investors and the leadership team. E-commerce enabler Ace Turtle bagged $34 million from Stride Ventures, Tuscan Ventures and others, while Pando got $30 million from Iron Pillar, Nexus Venture, Partners and more. Aviation platform Zest IoT got $6.5 million from Ivy Cap Ventures and Loyal VC, while credit card platform Kiwi got $6 million from Stellar Venture Partners and Nexus VP. Now on what's brewing, on to some good news today. Supply chain software startup Pando has announced Series B funding of about $30 million. The Chennai and Silicon Valley-based startup now has a total funding of $45 million, with plans to deploy this money in building forecasting models and global teams. In an exclusive chat, Pando's co-founder told my colleague Jude Sanith that the startup plans to break even by the year end as it targets threefold growth in the same period.
All of the problems that you mentioned have existed from before. Labor shortages, inflation, port congestions and all of that. But they're really more pronounced now because of the recent geopolitical uncertainties, the pandemic and all of that. So I think in terms of just technology investments, I think companies are going to double down and now realize that supply chain risks are more pronounced now and they have to invest in these spaces. Pando digitizes, optimizes and automates the order to fulfillment process. So it's hard to say that we will focus on this product or this area, this module, versus just looking at the entire platform. So we will double down on making every order, every transaction as efficient as possible.
Right. And even as, Abhi spoke about doubling down and how companies are in this mood, so to speak, even as we've seen disruptions in the last few years, Nitin, I have to ask you, you are clear on where your position lies, and that is the enterprise space, insofar as developing this technology is concerned. What kind of growth prospects do you see for the business in these areas? What's that growth number going to be like going forward?
Sure. You're right. I think Pando has been focused on the large enterprise from day one, and I think in that way we are unique and hopefully have an advantage in the long term in the global markets. And so if you look at our customer base and and talking about growth, I think we've grown about 2.5 times in the last year. We've grown between 2 to 3 times every year for the last 4 years. From our first customer, which was a Fortune 500 manufacturer, to the last customer last week, or the latest customer last week, they've largely been very large Fortune 500 manufacturers, distributors or retailers. So our focus on large enterprise will continue. In the coming year to 18 months, 12 to 18 months, we're projecting about 2.5 to 3 times of growth. We'll continue in that ballpark, but also in this macroeconomic environment, I think, not just big businesses, meaning big growth businesses, but good businesses, meaning high profitability businesses, will get built. And it's not a trade-off between good and big. Great big businesses will get built, and we're hoping to be in that fourth quadrant of high profitability, high growth businesses.
Right. So what's that revenue outlook going to be like? And when do you turn profitable, in a sense, given the fact that there's clear focus on that aspect of business?
Sure. Today, as of today, we're close to about $5 million in revenue. We're expecting that to go between $12 to $15 million in the next 12 to 18 months. We are at about 1:1.5 of what they call burn ratio, a metric in SaaS, which is for every dollar that we earn, we spend about $1.5 in spend. By the end of this year, we'll be at 1:1, bringing us closer to a break even. So I think we'll stay focused. I think so. The theme in general is focus, prudence, and velocity for growth, rather than dispersing resources, energy, and capital to be able to sort of do more things.
Absolutely. And how much of that, Abhi, will be focused on building great technology in terms of taking the story forward? Because, you are talking about companies doubling down. Disruptions have meant that tech will have to obviously come to the rescue. How important is this going to be going forward? And how much of this funding do you think will be spent purely on this front?
Yeah. The ideal situation is that we spend nothing more on technology, right? But obviously, I think we're going to start templatizing for nuances for different industries, building low-code abilities for different industries to just spin up Pando and go live in as low as a quarter. A lot of sort of forecasting models that continuously need to keep evolving for both demand, supply, pricing, different models that need to come through. So I think a lot of investment in that area, but I think we're going to be focusing on expanding our global delivery and marketing and sales teams as well.
In terms of an outlook on the magnitude of funding that you're looking forward to, any ticket size for your Series C round of funding?
Yeah, I think just with this funding round getting done just now, I think we're focused on the ticket size of the next deal and the amount of value that we can deliver to customers. customers. So maybe on that front, we currently, our ACVs, or contract sizes, are about $300,000 in North America, $100,000 per customer in India, and in Asia. And so we're looking to expand that, and a lot of our energy is focused on.
And what's the number that you're
today.
focusing on in terms of expansion?
Yeah, it's interesting because these are large global businesses, and like I said, they expand from one geography to another, one business line to another, and so on. And so really the long-term value or the lifetime value of these businesses runs into millions for Pando. We're not even scratching the surface in terms of either the amount of value that we're delivering to these companies, or in turn the revenue potential or share of wallet that we're able to get as a consequence. But it's tracking right in towards the top. So we're hoping that in the coming year to 18 months we'd be able to double from 100 to 200,000 in Asia, from about 250, 300 in North America to about 600 to 700. We're seeing early signs with some customers expanding closer to 1 million now. So hoping to continue on that trajectory.
And last question before I let you go. I'm sure plans of going public would be something on the horizon, especially in the medium to long term?
Yeah, absolutely. I think the way we sort of think about it, we talk about it a lot at Pando, that we want to build a business that sort of outlasts us, that we can be proud of and create a legacy. And in doing so, I think the only way to do that across a long-term horizon is really not just to build a big business, but to build a good business too. And so, I think the IPO plans will be crafted around the time we hit $150 million in ARR. And at the current growth rate, that's about 3 to 5 years out.
Well, that was Pando outlining its future growth plans. Time for a quick break. Up next, Masai School has placed over 3,000 students in 1,000+ companies in India. We take a look at the company's growth and future plans on the other side.
Can you start banking with Asia's safest bank instantly? Yes, you can.
But can I also find a branch before I finish this?
Yep, on your phone and at 500 plus branches in India.
And what if I need a bank for my business?
We've got you too. For not just small businesses, but for the really big ones too. Live more, bank less. DBS.
What if you could get your goods to the right place at the right time all the time? With IBM Consulting, AI-powered software can help automate your supply chain so products can be ordered, produced, and delivered more efficiently. What will you create? IBM. Let's create.
While a general has the power to cool, even in the hottest summers, its sustainable technologies help fight climate change and protect our planet. General, the extreme machine.
Delivery. There is a large block. Understand in the block deal, the leading private equity investor was a seller. BHEL is buzzing in trade today, and there is an anticipation of a large order coming for BHEL very soon. The promoter entity of Adani Group, understand from sources, were on the selling side, and a large leading US-based fund was a buyer in today's block. We have confirmation of both. The promoter entities are sold and have raised 15,500 crores by selling stake in the 4 group companies, and the buyer is GQG Partners.
Tune in to NSE Closing Bell as we spot deals before they happen, decode their impact on stock prices, and help you stay ahead of the markets. CNBC-TV18. Follow the leader.
Four-year-old skill and job tech startup Masai School has ambitious plans. It wants to grow its revenue 5-fold in the next 3 years in what is actually a tough time for the tech sector. Masai has now placed more than 3,000 students in about 1,000 companies in India and is targeting a revenue growth of 150 crore rupees in FY24, as well as an expansion in headcount. Joining me now is the co-founder and CEO of the company, Prateek Shukla, to talk to us about Masai and its roadmap ahead for growth. Prateek, thank you very much for your time here. Let me specifically come to you about this revenue increase that you projected in the next 3 years. What is going to drive this kind of growth? Because as I was saying, jobs, yes, hard, EdTech sector, even worse impacted. It's not just the macro headwinds. One of the largest names in the EdTech sector recently we saw, getting a lot of negative limelight, and that does tend to have an impact on investor sentiment. How are you targeting this kind of growth in this environment?
Thanks, Ritu, for inviting me, first of all. To answer your question, so one thing which we need to basically separate out is job tech versus edtech. So edtech, we have seen a lot of challenges, but when it comes to job tech, I think the need for the skilled workforce in our country is going to increase manifold in the upcoming years. That's first. Second important thing is we truly believe that this era is going to, or this decade actually is going to belong to tech and tech-related domains. And that's why Masai core focus is on tech. So we believe that there's a huge demand. And to give you a perspective, we have currently 9.5 lakh students fresh out of college gets into IT sector in the country, which is growing. So 2 years back, that number was somewhere around 7.5 lakhs. So that is growing rapidly. And when it comes to the kind of revenue growth that we are projecting, it is still very conservative. We can definitely basically grow beyond this.
Conservative growth, a 3x growth is conservative, Prateek. Well, we hope that does come true. But, tell us what the current run rate is. Where are you at? You're targeting, 150 crores in FY24? And this is on the back of what kind of growth that you've seen in the last couple of years, especially post-pandemic?
Got it. So, Ritu, basically, in our case, our program duration is 8.5 months. Okay. So as you know that we don't charge any upfront fees from our students. Student once enter into a program, once they graduate and start earning about 5 lakhs per annum, then only they pay us fees. Okay. So all the growth that we are seeing in this particular financial year is the hard work that our team does in the last year. Okay, so all the students, those who were enrolled in Masai School from July till now, is going to basically graduate in this financial year, and that is something which is going to translate into the revenues that we are talking about. We did close to 2,200 placements last year, and we are going to double down on that to 4,500 placements in this year. So that's one way of basically how the revenue is going to basically come in. And second is we have recently started a program which is meant for second year and third year college students while they are studying in college, so that by the time they graduate, they also start they also have a job in hand. So combining both these programs, we believe that 150 crores is something which our team is quite confident that we are going to achieve it.
But Prateek, tell us a bit about your revenue model. You just told us that, students don't have to pay an upfront fee. It's only after they get a job of a minimum 5 lakhs per annum that you start charging them. So, what is the revenue? Is it largely from, the people you're tying up for hiring, or, where do you earn your money?
So the student have to pay the fees once they start earning money. Once they get to a job, then only we recognize the revenue. So what we do is we work with NBFCs, those who basically underwrites this entire pay after placement agreement. And NBFC basically give us the money upfront, and then they collect the money from students over a period of 36 months. The fees of Masai School is 3.5 lakh rupees. So over the period of 36 months from their salary, the student pay the EMI to the NBFC, and we get the money upfront. So that's the revenue model primarily of Masai School.
Got that. You were also talking about expanding what you have and offer newer courses for people in their final years to be able to get a job. What are these specific courses you're looking to add, and what sort of revenue increase will that lead to immediately?
So we have recently started Career Accelerator program, which is meant for colleges, students those who are studying in second year or third year. So Masai School primarily, right from the starting, right from the inception, were always focusing on the graduates and people those who are ready to get into jobs. But there is a clear market which is existing, those who wanted to do Masai School course, but they are not ready to get into jobs right away. They want a slightly longer duration program which they can do with their colleges. understanding from the need of those students, we have conceptualized this program, which is meant for second year and third year college students. And we have recently started this program like in January this year. And since then, we have seen this program in itself is gaining a lot of popularity in colleges. And what we believe is that out of 150 crores revenue that we are targeting this financial year, around 1/3 of it is going to come out from the Career Accelerator program.
Oh,
and it's going to be from.
That's quite significant, Prateek. But, give us a sense. So you said about 9,000 students have enrolled into Masai School so far. You've placed only 3,000. Is that the sort of rate? And how many more students are you adding on a monthly basis? Say, by the end of the fiscal, how many students would you have?
Got it. So 9,000 students is the overall number of students, those who are studying in Masai School across different learning tracks. So far, we have been able to graduate roughly around 4,000 students. And we have been able to actually lesser than 4,000 students, and we have been able to place over 3,000 students so far. Our current placement rate is 91%. When it comes to the addition of the students, we are very cautious in terms of the kind of students that we take into Masai School. Although we don't have any eligibility criteria apart from high school completion, but we take students from all kind of backgrounds, and currently we are intaking close to 500 students every month.
Prateek, thank you very much for your time here on CNBC-TV18. It was a pleasure speaking with you.
Thank you so much, Ritu, for having me.
Well, moving on, a pandemic-born startup from Mumbai is seeking to take on Zomato and Swiggy in India's food delivery market. From offering a SaaS platform to restaurants during the #OrderDirect movement to now squarely challenging Zomato and Swiggy in their own territory with a discovery app. Akhil Vishwanath finds out how the startup is all set to disrupt the duopoly of Zomato and Swiggy. Take a look.
When a startup comes along claiming that it is challenging Zomato and Swiggy in India's online food delivery market, how is it even possible not to take any notice? Well, Coca-Cola has not only taken notice, but has made an investment in the startup recently. Not too long after Jubilant Foodworks, which runs Domino's in India, picked up a stake. I'm talking about Thrive, and just how is this startup challenging Zomato and Swiggy? Let's find out. When the pandemic struck in 2020, as #loyalty, the startup in its previous avatar was mostly helping restaurants with a customer management software and loyalty programs. With only 3 months of capital runway left and the lockdown in place, the co-founders were looking for a way to survive before they found the idea for Thrive.
We realized with our conversations with restaurant partners that due to high commissions charged by aggregators and no access to customer data, they had no ownership on their brand, and they had no way to kind of scale up their brands as well. And with the revenue that they were earning out of aggregators, they were not really making too much of money. It was just helping them with operations, but there was not any profitability out of it. So the idea for us with Thrive and the ordering platform was to enable and empower restaurants to scale up their direct ordering business, so that they could start accepting orders directly from their customers itself.
Thrive knew restaurants had loyal customers and started helping them build their own microsites by integrating third-party delivery partners. But the kicker was, Thrive charged just 3% commission, at a time when Zomato and Swiggy were charging up to 25 to 30%, which even made the National Restaurants Association of India, NRAI, think of setting up its own food delivery platform. But Thrive did the job. In less than 3 years since the pivot, it has scaled to 14,000 restaurants in more than 80 cities and has processed more than 1 million orders. For FY 23-24, the startup is targeting a GMV of nearly 100 crore rupees.
The first thing we wanted to do was break up the commission structure, because what we're trying to do is actually facilitate a transaction rather than dictate ownership on the customer data. This customer is actually a customer of the restaurant, not particularly a customer of the discovery platform.
Given the duopoly of Zomato and Swiggy, #OrderDirect is quite the trend. For instance, if we take biryani, which is India's most ordered dish for lunch and dinner, big brands like Biryani Blues and Biryani by Kilo have been aggressively taking the native route to save on commission. But Thrive feels that not all restaurants and cloud kitchens are easily discovered by consumers. So, to solve the problem, Thrive is piloting a consumer-facing discovery app in Mumbai, building on its B2B partnerships with restaurants.
Automatically, when you launch a discovery platform, a lot of people start talking about competition with larger players. However, our aim with this is very different. With the discovery platform, there's a chance for us to change the economic structure over there. About 30 to 35% of the restaurants on our platform, and we expect this to grow, are passing on this price benefit as a 15% or a 20% cheaper option or cheaper prices on the platform as a Thrive promise to consumers.
But can this work is the question. Zomato and Swiggy continue to struggle with poor unit economics, delivery costs being a pain point. However, Thrive believes it is this third cog in the wheel of online food delivery that keeps it lean and nimble, as it doesn't run its own fleet and instead works with third-party logistics players such as Shadowfax, Borzo, Dunzo, and others.
3PL, we work back with other logistics partners, so that's not a cost that we incur. The charges are passed on directly to the consumer. We've really never felt the need, at least up till now, and at least 5 times our scale, to really build in our own fleet and incur those costs. The current players in the ecosystem have done a fantastic job in the past 10 years. And what we think is a positive disruption is this to become a positive sum game for every stakeholder and the entire ecosystem.
Even as the jostling between Zomato and Swiggy continues, there is a slowdown in India's $5 billion food delivery market. Zomato founder Dipinder Goyal has pointed out that there is a surge in dine-out and the boom in travel has hurt order frequency. Another factor is that most of the revenue still comes from the top 8 cities. 5% of the users account for a third of the orders on Zomato. Now, having said that, the long-term opportunity is scrumptious, and as more cities join in, there can be space for more players at the table, even for Thrive. With camera person Prashant Huge and Balbir Singh, this is Akhil Vishwanath for CNBC-TV18.
With that, it's a wrap on this edition of Startup Street. More news and updates coming up on the other side.